You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Hello, Jim. Good to be with you.
Are we shaping up to see a nasty October in the markets?
Well, there's been a slip in the senior stock indexes. You had exuberance, and then you started having some divergences with one of the leading exciting groups, the all the small caps and the Russell Small Caps, RUT, began to diverge 5 or 6 weeks ago. And then you have volatility. You had a very complacent market with standard volatility measures, the VIX down to very low. Then the one that really helped out, I think, on our work was a long-term model we have. It registered an upside exhaustion move for the S&P, and that was on a monthly reading in August and in September. And the last time we had readings like that was in the early part of 2000, as that bubble was blowing out. So these, you can sense the excitement in a market and the confidence, but it's best to measure it. And that was one measure, and then there was another one came in. We laughingly call it the Hindenburg Omen, where it has to do with upside volume and downside volume and various spreads. So this one came in a number of weeks ago rather distinctively. So, and then you had the sentiment figures where they keep track of the market ladders, what they're writing, and whether they're bullish or bearish. And the bearish figure was down to 13.3% bears, which is the lowest, I think, since 1987. So you're talking some incredibly focusing technical and sentiment numbers. So then you wait and say, okay, well, now what's going to happen? And then the markets have corrected back. The Europe market has been softer, and that stocks index in Europe took out important moving averages this week. The S&P took out on just the 50-day, and it's not yet really threatening. But what we see over in the credit markets, and we should say that while there's a strong belief that central bankers can actually manage interest rates all of the time, and also they've done a heroic effort here at lowering long-term rates, there are some things that they can't manage, and that's the credit spreads, and that's the difference between investment-grade bonds and junk bonds. And so we're plotting that, and in 2000, and when spreads narrowed in, and then they turned around and started to widen, and that's what happened this year during the summer months, came down to, 148 basis point spread between the triple B bond and treasuries, and then by steps it went up to 154, then checked back to 150, and it really needed to break above 150 to become kind of a warning signal, and that managed that on Friday. Then this week it got up to 161, so it's now moving well, and so we compared that to 2007, and in the bubble year of 2000, and the patterns are similar, and so if this spread continues to widen, it'll really kill the speculative enthusiasms. And the other one is the yield curve, which is the difference between shorter maturities and longer maturities on treasuries, and it has been flattening with the boom as short rates rise relative to long. But it's kind of getting stretched technically and not yet rolled over or changed direction. So these are two items that the Federal Reserve cannot control when you get to an extreme. So as this turns a little more, it'll be disquieting to the overall financial markets.
Any particular area that's going to be the bellwether?
Yeah, the bellwether would be just watching the S&P, and if it takes out the 200-day moving average, that would be one step. The other thing is that the commodities have been weak, and we should go back to 2011, and that was the last really big commodity rally, and it made it into, I think April or May of 2011, where you had most commodities plus gold and silver, particularly gold and silver, very speculative. And we have another very long-term model, and it doesn't click in all that often, but this is what we call our momentum peak indicator, and it was clicking in on that one. So it suggested that that would be a cyclical peak for commodities plus gold and silver, which turned out to be the case. So then we come down into December, and most commodities that we were following became very oversold, and that's where we looked for, we call it the big rotation, where you'd get a market play in the commodities, and essentially they rallied up to May and became overbought. We noted that. And then they've come down to essentially new lows. So last week, I can't remember when we talked about it, but it wrote about it that the one commodity that was defying weakness, if you take a look at the index for the grains, which is GKX, it was making new lows for the move. And then the other one, GYX, which is base metals, and it was soft but not yet new lows. But you had the CRB up there, or in a trading range, and mainly held up by the strength in crude oil. So that's where last week we thought crude has escaped the bear, but you have a seasonality in crude oil where it can fall down into, say, December or January, and then all of a sudden, whoop, bang, it got hit very hard, fell from, 92 to 88. So that one is interesting. Now, also there's a political aspect to crude oil, and if any of the Western governments were at all savvy, they would be encouraging crude oil prices to fall, because you have Russia in an unusually belligerent mode, and it needs money, and the only way it can get hard currency is by exporting energy products. So weak crude oil will kind of cut the funds off to Russia, and that was the case in the 1980s. Reagan had worked out a deal with the Saudis that as crude came down, they would not cut production runs, and sort of let it go. So it fell from, I think $35 to $10, and that pretty well bankrupted the Soviet government. So there's nothing like a little bankruptcy to change political tone. And so here we are. We now have weakening commodities in a period of time when the central banks, particularly the Federal Reserve System and the European Central Bank, have been reckless beyond anybody's imagination. So you have the old knee-jerks there where, bad Federal Reserve, therefore commodities are going to go up, and we're going to own gold and all the hard stuff. When Jimmy Rogers says you want to own stuff that if you drop it, it'll hurt your foot. And it's not working. The commodity prices and gold and silver just are not obeying the rules of the 1970s. But what you have instead is financial asset inflation. So here again, it shows that the influence of central bankers is not all that profound, because they also, like gold bugs, believe that if they really depreciate the currency, that goods will go up and services will go up and everything will be wonderful in the economy, but instead you're getting essentially huge speculation in financial assets. And this shows up, as we mentioned, on technical measures for the stock market, and it also shows up on technical measures for the junk bonds, which became extremely overbought in July, and they're working their way down in price now, getting very close to perhaps a serious failure. So the markets are adjudicating the efforts of central bankers, and they're not looking so good. And if these stock prices and junk bond prices get a little lower, they will not really be looking good.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye. He's the Chief Investment Strategist for Institutional Advisors. Bob, with so many indicators looking down, and if people start bailing out of the market like crazy, where are they going to start putting their money?
Oh, yeah, that's always the question, and again, it's the public that decides. And here's the other supreme irony out there, is that the U.S. dollar is strengthening, and most of the critics of central bankers know that what they're doing is going to drive the dollar to zero, and they consider that to be the ultimate disaster. But we should go back to 2007, 2008, when during that contraction, and they described it as the worst financial calamity since the 1930s, U.S. dollar went up. And also just taking a look at an ordinary chart during the party of a bull market, it's with a weak U.S. dollar. And now that the dollar is going up, and it is really going up, and here was one of the things we noted in crude oil in wheat and the grains in July became very oversold. Now, all they could accomplish was a weak bounce and then fell to new highs. So this gets important in stock market things, because in the past, periods of serious and heavy liquidation have come out of an oversold stock market. So you had the wheat and the grains very oversold. They more or less paused a bit and then slid to new lows from an oversold condition. Then the other one we wrote a couple of weeks ago was about the U.S. dollar, that, earlier in the year we had a target that as the speculation in financial assets matured, the U.S. dollar would go up. And we had a target of 85, which seemed improbable. But at any rate, it gets to 85, and it becomes overbought. But then we look at previous times, particularly in the 1980s, when the big commodity boom that blew out in 1980, 81 was declining, the U.S. dollar was on one hell of a bull market. And so it went from overbought to overbought. So this was our conclusion a few weeks ago, that although the U.S. dollar was overbought, it could go higher, like an exceptionally higher move, which it is doing here, and it's up 1% here today. So there are fascinating things going on out there, and of course, with a stronger U.S. dollar, the quote in gold in U.S. dollars has been going down, and so has silver. So there's nothing you can do about it, and the U.S. dollar is going to remain firm, because in previous post-bubble contractions, one of the features has been is that the senior currency, which is still the U.S. dollar, becomes chronically strong against most other currencies and most commodities for most of the time, all helped out by which way the business cycle is going. So here we are, and with so many people positioned in gold, based upon the evils of the Federal Reserve, people position gold because they hate the Federal Reserve. Now, that's not a reason to own something. So at any rate, gold's going down, and it's approaching the low, just under 1,200 of a year and a half ago. It could hold there, who knows? But then we look at it as an investment in the gold mining industry, the gold shares, which depends upon their profitability. And that really is the ratio between what they're getting for what they mine and the cost of mining it. Now, a quick way of figuring that one out is to take gold and divide it by a commodity index, and that sets a cyclical low when you have the orthodox investments, such as the stock market, setting a cyclical high. So here we are. Our gold divided by commodity index set what we thought was an important low in June. By late July, it had set the uptrend, and then it churned around for a while, and it needed to break above 3.90, and it did that this week because it's up to 0.395, that's really setting the uptrend in gold's real price, which once the heaviness in the stock market is over, then the gold shares can advance. So our view on the gold stocks was that we'd wait until late in October, maybe early November, for the technical opportunity to begin buying them. And so what we got two things looking at us here. Timing, which is approaching, 1 week at a time. And then the other is we want to look for technical oversold in the gold stocks. So somewhere, let's just guess somewhere late in the month, early November, there could be the buying opportunity for the gold sector.
Bob, thanks a lot for chatting with us.
Always good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.